As you're looking at these companies, how much of the value creation plan is optimizing for these kinds of, I'd say, risks on the cost side, where there's maybe like a standard cost base, but then there's like flex of based on exchange rates or supply chain costs, like there's a ton of value creation opportunity. And how much of your focus is on acquisition and optimizing for growth and things like that?
We don't underwrite acquisitions as a part of our underwriting. So, we're looking at the base business. The VCP drives anywhere from 25 to 75% of our return in the investment. The more it drives of the return, the more I want to buy the company, almost indifferent of price at some point, because there's so much that we can do, which protects the downside in these companies. If they are going through a contraction, the stuff that we can implement can actually like cushion that contraction for the company. In some cases, we shrink the top line of the business. We bought a company from Sun Capital Partners, really good private equity firm, and they made more than 3 times on it. We actually shrunk the business and doubled EBITDA by helping the company, focus on price elasticity of demand, looking at their customers and their markets and where they had more pricing power and where there was more opportunity, looking at the supply chain and, managing the supply chain better. And then, of course, making the factory more efficient. There's always at least 25% of the return. I would say on average is probably 45% of our underwriting. Now, there is growth because we're buying companies that have grown, and we are using leverage. We have all those traditional models, but we have the extra one, which is the value creation plan.
Explain that to me. Like if whatever the value created is 100%, you're saying 25 to 75%. So let's say on average, 50% is from the cost-based side, or optimizing existing operations in the base.
Yep, cost and cash.
Is that the other 50%? Like what is the rest?
It's growth, right? These companies are growing and they're growing better than the industry average is over their life cycle. Also the cash flow generation from operations that generates a return. The leverage, we're still 40% debt. So we're using debt as a tool, but we're not beholden to it. So in a lot of private equity firms, when they couldn't get 65% leverage and it blew up their model, we have this other operating lever. And so we really rely on it. It's real sweat equity if you think about it.
And you can control it.